Hello everyone, welcome to this channel. My name is Ruben and today we're going to talk about the earnings results from Teladoc. They just reported the second quarter earnings results from 2021. So let's go. Let's start with the revenue. The second quarter of 2021, the revenue and the adjusted EBITDA. On the left, you have revenue going up 109% year over year from 241 million last year to 503 million in the last quarter. And for the adjusted EBITDA, it actually grew even more with 154% year over year from 26.3 to 66.8 million. And now they make a distinction between access fees and visit fees in terms of revenue. On the left, we have access fee revenue that grew 138% year over year from 182 to 434 million in the last quarter. And if you focus on the right, we have visit fee revenue that was nearly flat, like only 1% growth with approximately 59 million. The next category that they report on is a distinction between the United States and international. Well, in the United States, they are growing faster than in the international markets. So for the left, for the United States, it's up plus 121% year over year from 211 to 465 million, while for international revenue, it's up 24% year over year from 30 to 38 million. Revenue, membership and PMPM. Revenue we already covered. So on the top right, we have the United States paid members. While this is very flat, Teladoc is stuck around 51 to 52 million approximately. So there's not much growth there. If we go to the bottom left, for chronic care enrollment, they're growing quite quickly, to be honest. And for the last year, they had 493,000. And in the last quarter, they grew that to 715,000. And PMPM also doubled year over year. And then we have the key operating metrics. On the top left, we have the visits. The purple color represents the visits in the United States and the blue color represents the international visits. Well, the visits in the United States are up from 2.3 million to 3 million approximately in the last quarter. And for the international visits, it is up from 453,000 to 477,000. Utilization on the top right is growing as well from 16 to 21.5%. The platform enabled sessions on the bottom left, it's steady, approximately 1 million. And if we focus on the bottom right, we have the data points. Well, Teladoc is collecting data and this is going up steadily as well. And then also the expenses. Well, the question is, why did they spend more than expected? This has to do with the technology and the development, which is up from 23 million to 81 million approximately year over year. The acquisition and integration and transformation costs. Well, Teladoc is still in the process of integrating Livongo and Teladoc. So they have to go through the cost phase right now in order to generate these synergies for the future. And I also find it remarkable that the depreciation and amortization is up more than 5 times. So they had some depreciation expenses as well. And last but not least, the net loss per share, basic and diluted, was 86 cents per share. And lastly, we have 4 additional highlights for Teladoc. 1, they signed a significant new agreement with HCSC to provide their suite of chronic care solutions. The second one is they also signed multiple new chronic care relationships in the hospital market. And they also launched myStrength Complete, which integrates capabilities across Teladoc and Livongo to deliver a comprehensive mental health program for consumers through their health plan or employer. And lastly, Teladoc announced a collaboration with Microsoft to integrate Teladoc's Solo platform for health systems into Microsoft Teams to streamline clinician workflows into a unified experience. Now I want to share 2 highlights from the conference call with you. So let's listen.
Thanks very much. Good afternoon, Jason. Can we just spend a couple minutes talking about Primary 360? I know you said that you have a significant national payer. Can you maybe just give us an idea of how many members that is? Are they currently on your platform? Are they new members? And then also, can you just give us an idea of services that will be rendered and how the payments will work? Will it just be kind of a traditional collect a PMPM and then have a visit fee, or is it something that's going to be different with this national payer?
Yeah, so thanks, Lisa. We're really excited about Primary 360, and we're poised already to launch several large national employers, Fortune 1000 employers, in the back half of this year, as well as having signed a significant national agreement that you mentioned. And we're in very, very late stage discussions with several other large payers. So, this is an area that we have leaned into because it capitalizes on the full breadth of our capabilities, and we believe that we're unmatched in the marketplace. And what we're hearing from prospects is that that's really validated, and they're excited by the combination of a virtual primary care relationship, a team approach to care using data and technology to deliver the best care, and also to do it in a way that aligns with a virtual first plan design that really incents care that gets the consumer to seek virtual care first, such that we can make sure that they get the optimal care, whether they need to be seen in person or can be taken care of virtually. With respect to the pricing model, I think the early pricing models you'll see will be a PMPM, likely a higher PMPM than we've seen historically for example, our general medical or any of our individual services, and then a wide array of visit fees that reflect the value that we bring. So, for example, a 30-minute introductory visit with a primary care physician obviously is worth a lot more than a virtual urgent care visit to take care of someone's strep throat or sinus infection, for example. And so we expect to see increase on the PMPM side as well as on the visit fee side. As we look into the future, we're excited about more value-based reimbursement structures that rewards us for delivering better outcomes as well as reducing the cost of care to where we ultimately see ourselves sharing in risk with the payers and our clients. And so, that'll be an evolution over time, but we're actively talking to clients about that evolution, even at the beginning of our relationships with them. So we're very, very excited. I would say stay tuned relative to announcements and details about the new clients that we expect to launch. I'm obviously can only say as much as I can say, and I think we've gone about as far as we can at this point, but stay tuned for some exciting announcements.
Yeah, but just to punch one point home, the pipeline for Primary 360 that we are seeing is very, very strong. If I look at the growth in the pipeline sequentially, we are seeing real strength in the pipeline, and that to me is one of the important markers for our confidence in growth as we look ahead.
Good evening, guys, and thanks for taking the question. I'll say, Jason, I can't believe this one fell all the way to May, but is it too early to start talking about the selling season for 1/1/22 starts? And I'm going to try to one-up Charles and say, HCSC aside, as we look forward, how should we be thinking about where growth comes from going forward? Is it more the upsell of things like Primary Care 360 and myStrength, new footprints, or visit growth? And the question I'm really trying to get to is like the evolving growth algorithm of the company, whether when in the past we were looking for new footprints and visit growth, and now it seems to be more about wallet share gains. I just kind of love to hear you talk about that.
Yeah, thanks, George. I'm happy to talk about the selling season. I'll stop short of exactly sizing the pipeline, but I do want to give some color on that. And let me walk back to the beginning of the year and what we were saying from the beginning of the year and how that's evolved the last couple of quarters. The beginning of the year, we talked about the fact that our pipeline was robust and it represented 50% growth in the pipeline relative to the same time the year before. But we also said that the pipeline was weighted toward more early stage deals, right? So it was earlier in the process, but the gross size of the pipeline was significantly larger. Since then, as you can see, many of those deals have progressed to closing, right? Including the East Coast Blue Plan that we talked about on the last quarterly call, including HCSC, including the large health system in Florida that we talked about rolling out chronic care management with. And so, those deals are coming to fruition, as well as the primary 360 signature that we just talked about. So, those are coming to fruition. We're happy to see those close, and they've moved through the pipeline. But we've also seen, as I look at our pipeline today, our late stage pipeline, as those deals have progressed through the pipeline and our sales force has made progress on those, our late stage pipeline at this point is 20% greater than it was last year, right? So we're now at a point where we have great visibility into what that's going to look like, because we've successfully moved those deals through the pipeline. And what's most exciting to me is, whereas last year 50% of our bookings were multi-product bookings, this year at this point we're up over 75% in terms of our multi-product bookings. And after seeing an explosion in our average deal size last year, our average deal size in our pipeline now is up another 10% versus where it was last year. So when I put all of those things together, that's what gives us confidence as we look into 22 and beyond. And, certainly some of the deals that we've announced already are part of that. But I would say I'm at least as optimistic and excited about what's still in our pipeline as what we've already closed. So I feel very, very good about that. Mala, anything you want to add on the pipeline? Otherwise, we can try to squeeze in George's follow-up question.
Nope, I think said it all.
So, with respect to the growth algorithm, I appreciate the question, and certainly we've given a lot more insight into the growth of our PMPM, the importance of multi-product growth, the importance of multi-product enrollment for chronic care members, and all of that really lends itself to our competitive advantage with respect to delivering on whole person virtual care, as opposed to all those point solutions out there that can only deliver one thing. And I think what you'll see is that will continue to be reinforced as we continue to execute on converting that pipeline into bookings and converting those bookings into revenue. And what I would say is, hold tight a little bit for us. We anticipate having an investor and analyst day toward in the fourth quarter, where we expect to give much more insight into the long-term growth algorithm, the levers for growth, and why we feel so confident about continuing to deliver on both the top line and bottom line growth over the next several years.
And I would also add, George, just a couple of additional points. We haven't talked much on this call about utilization and the very significant expansion in utilization we delivered during the quarter. And by the way, we have been delivering every quarter for the last several quarters. People were asking us last year, do you think the strength in your visit momentum will sustain? And as you can see from the results we are driving, we are seeing strength, and we are seeing very strong growth in our visit volumes, despite the fact that infectious disease volumes are down year on year, right? With all of the pandemic measures in place. And so what we are seeing is a strong growth in our non-infectious disease volumes. We are seeing very strong growth in our specialty volumes, and those are fueling utilization expansion. I would also say, with the growth in specialty, we are seeing more stickiness. Whether the fact that we are seeing repeat visits growing, whether it is that we are seeing more of our members doing multiple visits or using multiple services. So all of that to me is that in conjunction with what Jason talked about in terms of multi-products from a booking standpoint being over 75%, the fact that we are really penetrating and growing enrollment in multiple chronic conditions, to me it is actually about the growing relevance we have to serve the healthcare needs of our members and our clients. And you will see all of that in terms of how we talk about our growth in the years ahead later this year.
So a quick final thought on the earnings of Teladoc. While Teladoc is in the process of realizing synergies between Livongo and Teladoc on the one hand, therefore they're making expenses, doing the necessary investments to make it pay off in the future. I believe that in the short term you can benefit from this dip, from this lower price, and that it will pay off in the future. But if you are an investor in Teladoc, you need to have this long-term view. Don't buy this stock for the next quarter, because it can be worse. But for the long term, I'm still bullish. Thank you everyone for watching this video. I really hope you enjoyed it and that you actually learned something, and see you on the next company.